it's oftentimes hard to see what's actually happening with the internals of a stock market with the incredible amount of data that can be pushed to you or thrown at you. So what I wanted to do was show 7 price charts comparing the S&P, exactly the same ratio, everything, and where the other 7 price charts are compared to the S&P 500 to see what is breaking down, what is holding up, where money is flowing, and what we can learn from this pretty, for a lot of people, this pretty scary sideways 13% channel the S&P 500 is in over the last 17 months. Hey everybody, this is RC Peck, and this is my weekend podcast, and the theme for this weekend is weight of evidence. So I want to compare 7 price charts exactly with the S&P 500, and I thought of kind of a cool way to do this, and I've never seen it done this way. And, after you create something, or I don't want to say I invented this, but after you create it, it becomes so obvious and it's so insightful. And so with that, I want to show you 7 price charts, all 7 of them being compared against the S&P 500. Now, let me just quickly zoom through them so you can see how the top price chart does not move, and I'll explain this in a second, but notice how the top price chart doesn't move, but the bottom one does. So what I want to do is show you 7 price charts, if I got my counting correct, compared to the S&P 500. So let me show you what I have. On the top half of the screen, you have the S&P 500 going back to mid-October of 2014. Okay, and you see 3 circles. Circle number 1 is August 24th. Circle number 2 is September 28th. And circle number 3 is January 15th. And so I have the circle on all 3 of them on the S&P chart to show the bottom of the 13% channel it's in. The first circle for the S&P, I'm connecting it to the price chart below, so those 2 first circles can connect with each other. And I'm not going to connect the other 2, but what I want to show you is when the S&P fell down to its low in August 24th of last year, U.S. bonds, the price of U.S. bonds spiked up to here, up to 107. But the next time the S&P fell down to basically the same circle, bonds were slightly higher. So these are the 7 to 10-year bonds. So that means by the second time the price hit the bottom of the channel for the S&P, the price of bonds was up about, if I get this right, about a half a point higher. But then when you look to the third time the S&P is hitting the bottom of this channel, which was yesterday, January 15th, you see that the price of bonds were at 107, but now they're at 108. So it's way above this, which means each time that the prices come down and hit this bottom support point, more money has flowed into the 7 to 10 year treasury bonds. And that's noteworthy because people usually move into bonds when they're concerned and scared. So from this one measurement, people are getting more concerned with the third testing of the channel that the S&P 500 is in. The second price chart I want to compare the S&P with the 3 bottom resistance points is with the price of oil. Now, the first time on August 24th of last year, the price of oil was right around $40. The second time it tested that same bottom with the S&P, the price of oil was up $5. So a month later, it was up $5. But notice where we are today on January 15th. The price of oil is now down to $30. So it's fallen, depending on whether you talk about the September 28th one, it's fallen $10 or it's fallen $5 from the August 24th. But oil is continuing to fall. And I have said before that oil below $34 should start to be a concern for the world because maybe it's just more than too much supply. So oil is saying something's wrong with the world economy, or it's saying, man, people are really expecting Iran and the U.S. to export a lot of oil around the world. But I would say it's more negative than not. The third price chart I want to compare the S&P's bottoming 3 points to is the volatility index, the VIX. And if you look to August 24th here, the VIX spiked as high as it's ever been since 2008. But the second time the S&P came down and tested the same price support, the VIX was nowhere to be found. It was way down here. So that means the next time it tested, volatility was much lower. And now here we are the third time with the S&P testing the same price range. Again, the volatility is right down where it was the second time. So people are getting used to this price movement, and we can tell that because the volatility index is lower the second two times it did it. Now, this could be something called a divergence, which means the market will move up next week. The move next week is going to be pretty important to see what happens, and I think it's going to really set up a potential move up or down. We'll talk about that in a minute. The next price chart I want to compare it to is a ratio. So this is a ratio comparing an equal weighted S&P 500 fund, which is the ticker symbol RSP. And what that means is an equal dollar amount goes into all 500 S&P 500 stocks when compared to the cap-weighted S&P, which this is actually, I put SPX for the S&P 500, but it's actually SPY. So if you see this line falling below here, that means the mid-cap and the smaller cap stocks are greatly underperforming the larger cap stocks. And back here on August 24th, when we had our first bottom hit that support price of about 1875, you'll notice that this ratio is right here. But by the second time, a month later it hit it, it was nowhere to be found. The price was way below, which means even though the S&P kind of stopped at the same price, mid cap and small caps were much lower. And then the third time we hit this price support at kind of the 1875 mark on the S&P, what you'll notice is the ratio is nowhere to be found. It is way down here. And then what that means is, though the S&P is holding up, mid cap and small cap are not holding up. They are falling and breaking to new lows. And all things being equal, you don't want to see mid cap and small cap breaking down, but in fact, that's what they're doing now. So the larger stocks are holding up while the mid and the small ones are breaking down, and that's a negative. The next price chart I want to compare the S&P 500 to is junk bonds. So back here on August 24th, when the market bottomed first at the 1875-ish mark, you can see the price of junk bonds here is right around, and I'm using the ticker symbol JNK, which is an ETF, but it was right around 35.5. The next time the S&P hit the same zone, that 1875 zone, you could see that junk bonds were below. They were actually below. They weren't at 35.5 anymore. They were at 35, so they had lost half a point. And then the third time the S&P hit the 1875 range, you look down here and the junk bonds are nowhere near to be found. They're almost at 32.5, so they've lost ground. So the junk bond market is breaking down. Now, it was holding up last week, and that's something I actually talked about on the podcast, but it has now broken down and is accelerating to the downside. So that is definitely going to have a negative weighting on the market. Our next price chart that I want to compare the S&P to is just a set of international stocks. So the below chart, the bottom chart is EFA, which is an exchange traded fund, showing you the international shares. And again, if you look at August 24th here on the S&P and then go down here, we have a similar bottoming in the international shares. But the second time, a month later, the S&P bottoms in the same zone. EFA, or international shares, are clearly below. They've clearly lost about 2% more. And then we go to yesterday, January 15th, where the S&P bottomed at the same 1875. And check this out. The international stocks are nowhere to be found. They are way down here, about 8% below. So international is falling, small cap is falling, oil is falling, mid cap is falling. A lot of things are falling around, and it's only some of these are going to have to find a foundation because there's no way the S&P can continue to hold up in the face of, I don't want to say everything falling, but a lot of other shares falling. Now, what may be happening is people are selling their small caps and their mid caps and their international, and they're buying US large cap stocks. That absolutely could be happening. But there's only so much of that can happen until it breaks down. Okay, and then lastly, I want to compare it to the US dollar. And with this, I'm just comparing it to the ETF UUP. And same thing looking at August 24th here. If you look down at the US dollar, there was a bottoming here too. But the second time the S&P hit its 1875 range, the US dollar was higher. So that is very interesting to me because that means people are moving into the US dollar. And the third time the S&P hits the 1875 range, the US dollar is nowhere to be found in the same zone. It is much higher. So people are moving into the US dollar. So what's interesting is the fear of people showing up differently. So like the VIX is actually calmed down. That's a volatility index. But where people are having their money flow, say 7 to 10 year treasuries, the US dollar, that flow is increasing. So the flow to 7 to 10 year treasuries is increasing. The flow to US dollars is increasing. And people are taking money out of international shares, for sure, emerging markets, small cap, mid cap, and junk and oil. So right now, money is flowing to the US dollar, and money is flowing to that 7 to 10 year bond range. So what is the takeaway? I think next week's pretty critical. I mean, it's not hands down everything is breaking down except the US market, the US large cap market, but there are a lot of price charts breaking down, not being able to hold up. And I think next week, if the S&P breaks next week, breaks below, the next major support is about 10% below where it is right now. And that would still only be about a 21-ish percent correction. So well within what happens in markets, but the volatility could really start to accelerate. And if things really go sideways emotionally, we could see a much higher acceleration. And because we are at the bottom of that support zone, that kind of that 1875-ish support zone on the S&P 500, we could see a kind of a firming around this price. But what you're going to want to see as an investor, if you're bullish, is you're going to want to start to see the international shares firm up, the emerging market shares firm up. Even though I didn't show a price chart of it, they're worse off than the international shares. And you're going to want to see people backing off from the US dollar and backing off from those 7 to 10 year treasury notes in the US and seeing some firming. So next week I think is pretty important, and I'll keep an eye on that, and I will connect with you on that podcast next week. For members, you would have received the 30-day forecast this week where I do a deep dive into the other charts, commodities, physical assets, housing, showing you exactly what housing is doing and what upside is left of it. And we look into some great bond price charts and, of course, the stock market. So I'll have some more great information for you next week, looking at all the different sectors and which sectors are holding up the best and which ones are absolutely kind of collapsing on themselves. Hey guys, this is just another step in helping you protect your portfolio and your future. Until next time, this is RC Peck.